So last year, or at the start of this year, I would have told you the base case would be 20 because of the volatility collapse. But next year, the base case, if you do midterm math or returns after 20% year, it's actually like 11%.
Okay. Does it matter that this year was a 20% plus year?
Yes.
So,
well, maybe it matters after an 18, after a 31. Like, we're just stacking monster years. Does it have to pause eventually? I mean, I guess nothing has to happen, but how have you been so bullish for so long? Because you've been optimistic, and I've been watching you for a long, long time, and I know it's very difficult.
In person, Michael's been following you.
I've been stalking you. No, we call it following these days. It's been very difficult to stay optimistic, especially in public, right? You get a lot of shit for that. How have you stayed? How have you kept your eye on the ball?
Some of it's just... a lot of it's our work because there is, I think, like sort of larger structural factors at work that support the bull market. You know,
you and I talked about demography last time you were on.
That's right.
That's a big one for you.
Yeah, and just a simple observation, like most major companies are founded by people in their 30s.
Right.
20 or 30s, like whether it's Costco, Blackstone, Bloomberg.
Is that true?
Yes.
Okay.
I have a chart that shows the age of the founder. They're all in their 30s.
Wow.
But what about
most people expect that?
What about things like valuations and peak profit margins and all the things that can go wrong? Like, do those, I'm not saying that you're not worried, but how do you remain optimistic?
Yeah, sorry, but let me just finish because so if you have more people age 30, then you're going to have more innovation.
Okay.
And in fact, so we found that there's a relationship between the number of people age 30, 50 and the number of patents filed.
Is this just an American phenomenon or do you see this elsewhere?
So the U.S. actually is one of the few developed countries with a demographic tailwind.
Okay.
Everyone else is going the other way. Like Japan, China, Europe are going.
Well, the most amount of people in this country at a common age is what, 31 or
yeah,
something like that. All right, so we got them right where we want them.
Yep.
Okay.
So I would say to me, if I was just relying on demographics, that means we have a bull market through 2029 or 2035.
But there are other people that study demography that would look at this, the same data that you look at, and they would say the baby boomers are going to sell all their stocks and sell all their houses, and that's going to depress the economy.
But you know that's bullshit.
Well, we know now in hindsight that that's not how things played out. But I guess my point is arguments from demography solely can almost be made, like you can almost tailor your argument using the same data.
Yeah.
Based on what you want to.
It's a reality distortion field, right?
It is, right?
Yeah.
But can we have peak earnings for millennials without peak earnings for companies? Or is that a non sequitur?
Well, the in between is really how companies allocate capital. And so that's like if companies get too optimistic, then profit margins will collapse.
But they're doing the opposite. I know they're not. Not only they're not collapsing.
Because companies are actually overly cautious, so profit margins will keep expanding.
What do you got there?
Okay, so this is the number of people aged 30 to 50 in America.
Duncan, you have to get these charts from Tom later.
Yeah, but do you see the
Yes. Where are we now?
Where the orange line is. So it's turned up. By the way, the nadir, see this nadir? 2008.
Oh, wow.
Interesting.
That's very interesting. So we turned up when?
Yeah.
5 years ago?
And by the way, the nadir here was 67. Yeah, so it turned positive 2016.
Yeah, because these aren't people; these are consumers, right? Like let's call it what it is. This is a growing number of people who are in the household formation phase when you spend the most money.
And guess what? Peak earnings,
and also most productive in a way, right?
Peak earnings, peak spending. How is that not bullish for companies?
So personally, I don't think I'm at peak spending. I'm definitely at peak productivity. I'm just putting it out there. I'll probably spend more in the next few years. But I don't think I'll be any more productive than I was this year.
Yeah.
I can't imagine.
But take a look at this. See, this is the same chart below, right?
Yeah.
See the chart above?
Yes.
That's rolling S&P returns.
That's crazy how nicely that lines up.
Yeah. So if this plays out, S&P's 19,000.
Wait a minute.
What would
we're at 65.
What would a 19,000 S&P correspond to on the Dow? Is that 80?
That's a triple, so 100.
100?
Well, S&P's like 5, so like 4,700.
Yeah.
So this is...
Oh, wait, what did I say? What are you saying? Oh,
S&P going to 19,000.
It's closer to quadruple.
Yeah.
And that's by the time the people who we just cited as being 30 now are like closer to 50.
All right,
Correct.
but
yeah.
let's just stipulate that you're right and that these are structural forces. How do we survive bear markets? Because they're obviously going to happen. And are bear markets going to look more like they did in 2020 because there's going to be such a quick fiscal and monetary response? Or was that just a one-time shot in the arm because of COVID?
And demand for stocks.
And demand for stimulus.
No, demand for stocks. I need more stocks no matter what. So when they're down 5%, that's like them being down 15% a generation ago. I'll just take them down.
Are multi-year bear markets a thing in the past? I know it's a ridiculous question, but what do you say to that?
Oh, I think there is going to be a horrific bear market, but it may not be for a while.
And does it have to last an average of 13 months, which I think is the historic peak to trough? Like, can it be 3 months and we say, okay, that was a horrible bear market?
Yeah. When I was at JP Morgan, we wrote a report called The Guide to Bear Markets.
Yeah, I probably read it.
Every major bear market is actually a retracement of the bull market. So 127%. Every bear market's 127% of the bull market.
Really?
Yeah.
They
So
have to be that severe?
well, in other words, if you rallied 100 points, a bear market's 127 points
Down.
decline. Yeah. So you always you go below where you started, and then you're
Right.
27%.
But that subsequent bull market is then 500% of the bear market.
Correct. Yeah. So the
Historically.
Yeah.
So
So
that's
that's
why it works.
correct.
Okay.
But that level of wipeout, that drawdown wipes everybody out. That's why. So
Okay.
we'll have a bear market like that.
Not till 2024, though.
Or 2029. Yeah, maybe not till 2029.
Okay. So
At the lows in 2020,
so we have time.
we were back to late 2016 levels.
Yeah, so that's a huge retracement. But yeah, so I mean, I think we could we'll eventually have a huge bear market.
So I want to get into your outlook for 22. So you don't see that on the horizon in the next 12 months, which let's hope you're right. And I know when do you publish this?
When is this
It's going to air tomorrow.
Okay,
So when do you publish next week?
on the 21st.
All right, let's hold off on that. Let's get into the streets outlook, and then you could tell everybody why they're wrong.
Okay.
Our friend Sam Rowe is out with the usual suspects. I don't know how closely. Do you follow other strategists or not really?
I mean, people ask me all the time what I think of what someone else thinks.
No,
So-
I don't mean like what do you think of them personally or if they're
Oh,
smart. or not.
no. I know. I'm saying people ask me about their forecast, but I don't actually get people's research. So I know what people are saying, but I don't know their rationale.
Not even Barry Ritholtz's? I'm just kidding. So wait, so do you do that deliberately? Do you want to make sure that you don't get colored by other people's opinions and just keep that out of your purview?
You know, the reason I don't do it is I don't want people giving my research away for free. So I don't want to read someone else's research without.
I heard you have huge beef with Brian Belsky.
Brian. Oh, you mean in a dark alley? We fought it out one night at an Irish pub.
Not strategist wars.
No.
All right. So, Mike, what is this showing us about prior year returns versus next year returns? I think you threw this in the doc.
I did not. No, I did not.
Oh, was this me? Okay.
My take on the strategist outlook is they're always kind of the same. And I'm surprised more people don't go bigger to one direction because stocks are almost never up or down a few percent.
Yeah.
And I'm kind of seeing a lot of that. Like just eyeballing this, the biggest upside target that I saw was like 13% higher. Is that Yardini?
Yeah. I mean, I can tell you what some of the simple math I know that probably informs how we would think about next year.
I think you're more likely to be up 20% than up between 0 and 10.
Yeah. So the plurality of outcomes is double digit. Like in other words, even if it averages 7, it's usually like.
But most people that sit in this chair, the strategist chair,
Predict 8 to 10.
like if you predict 20 and we're down 5, you look like an idiot, even if your prediction was closer to a historical outcome.
Yeah.
If you predict 8 and you're down 5, all right.
Yeah. So last year at the start of this year, I would have told you the base case would be 20 because of the volatility collapse. But next year, the base case, if you do midterm math or returns after 20% year, it's actually like 11%.
Okay. Does it matter that this year was a 20% plus year?
Yes.
So,
well, maybe it matters after an 18, after a 31. Like, we're just stacking monster years. Does it have to pause eventually? I mean, I guess nothing has to happen, but
I mean, internally, as Josh was saying, it's already happened. I mean, a lot of stuff is
That's true.
peaked in February.
that's true.
so right, you go back to the market of stocks argument versus the index.
Well,
And you definitely see
JC
that.
will say investor enthusiasm peaked in February, and he's probably right on that.
So how do you disagree with? So how do you take it? Do you take issue with this from Michael Malbasan? Quote: This via Sam Rowe. If weak returns one year begat strong returns in the next, and vice versa, then you should see a string of dots somewhere on the chart that slopes down and to the right. Do we have that?
Yeah, we got it.
So meaning we should go down next year?
Basically,
this is showing that
total shareholder return, and then total shareholder return over the next year.
so it's just showing pretty much total randomness, more or less.
Yeah.
It's Brownian motion. There's nothing there. So how do you respond
Wait,
to that?
hold on. I think I see something.
Yes, that's sure. Buy it.
I would say
Yeah, well, let me finish sentence. Historically, there's been no discernible relationship between the returns during any 2 years as reflected by very low correlation. If there were anything to draw from this chart, it's the fact that most of the dots are clustered in the upper right quadrant.
And most of the time, stocks
In other
go up.
words, annual returns tend to be positive.
But there's probably more context that we could put on here, Tom. What do you think? What do you think?
a lot of context. I mean, I would put recession versus non-recession and business cycle.
Okay.
I would put midterm and like election cycles in here.
Are you writing a lot about the midterm for your coming outlook?
Yes, to an extent. I think it's going to play a role.
Okay. I think it's going to be absolute fucking chaos.
Correct. That's why in midterm years, the market doesn't do anything in the first half. Usually it's down.
It shouldn't this year. I don't think anybody should be making bold bets, year-end bets in January because
Yeah, watch me.
there's okay. Besides you, all right. But that does play a big role historically in the midterms. In what way, besides being back-end loaded? Like, what else does that tend to do to markets when you're in that year?
Well, in this case, there's just so much at stake, right? There's the virus policy response. There's infrastructure. There's taxes. So it's going to matter to consumers and to the markets. And as you know, these days, markets, because of scraping and alternative data, markets now react to what consumers do.
Yes.
Like before, consumers could do one thing and the markets would do now they do the same thing. Like, you saw Omicron panic in consumers and the market wobbled.
Also, so much of consumption is based on stock market wealth. Probably more. The wealth effect from stocks is almost rivaling the wealth effect from houses.
Yeah.
And I don't think that was the case 5 years ago even.